So deal structure. As mentioned previously, collateral. All our loans have to have one-to-one collateral coverage. And as mentioned, it's 80% LTV, loan to value on real estate, and 70% on machinery, equipment, or furnitures and fixtures. 80%, 70%, you can do it either way. From a credit score standpoint, anyone that owns 20% or more in the project, in the venture, whatever it may be, they have to provide a personal guarantee to the loan, and that's a USDA requirement. In that personal guarantee, credit score, usually we like to be above 680. If it's below that, we'll look at the score and kind of see what's driving the lower score. And if there's bigger baggage there, we'll address it and see what kind of information we can get from that. But then a personal financial statement is another thing we'll need from a guarantor to kind of evaluate and analyze their net worth, their other assets, their other business interests, and kind of see how experienced they are, and do they merit a $25 million loan to go purchase the JW in, I don't know, rural Arizona. Balance sheet equity. So when it comes to an existing hotel that took out a bridge loan last year to do a bunch of improvements, and now they're needing to refinance it into a term it out and get on a long-term loan, 10% balance sheet positive equity is what they need to show on their balance sheet in order to be eligible for our loan program. And that's a USDA requirement. If they don't have 10% balance sheet equity of the loan amount and they're below that, they will need to bring in that cash at closing to offset that equity. So most borrowers are able to leverage their balance sheet if they have the equity and do a refi or do additional improvements, whatever it may be, without bringing any money to the table. They're able to leverage their balance sheet completely. As long as cash flows support the loan that's being requested, they'll be able to do that. On acquisitions, like I said, when you're starting a new entity and acquiring an existing business or whatever it may be, 20% is usually a good rule of thumb on equity needed to bring in. And again, as long as cash flows support the loan that merits, then it'll work. Ground up construction, 25% is the minimum. So that equates to a 75% loan to cost. Again, cash flows have to support it, but 25% is the minimum requirement per the USDA regulations. Most borrowers on ground up construction projects right now, you're looking at probably between 30-35 on the most aggressive side. But historically, borrowers, you've seen borrowers bring in 40%, whatever it may be, but 25% is the minimum per USDA regs. Interest rate will be very competitive in the market. We're based off prime, and then we'll do a spread of 1.25% to 3% on top of that. That spread, again, is all dependent on the borrower, the credit worthiness of the borrower, and the business, right? How strong of cash flows do we have? Is it an existing business or is it a startup? If it's a ground-up construction hotel, is it a very experienced management team that's built ground-up construction hotels across the country? We'll look at a bunch of different variables to see what kind of spread that project merits ultimately. And then when it comes back to kind of touching point on cash flows and making sure the cash flows make sense is debt service coverage. Us as the lender, we like to be at a 1.25 on debt service coverage. It's a comfortable spot for the lender to make sure, if anything else happens in this space as well, if another, pandemic occurs or other reasons that the hospitality space or even that whatever industry that business in is will face any kind of headwinds and, business will slow down, that they're still able to comfortably, pay their debt and continue operations without stressing them too much. On any deal we underwrite, we do stress tests, so we'll make sure as well that we're not jumping the gun and getting into a deal that there is potential problems for down the road, right? And then term length, 30 years. Some loan programs in the USDA, community facilities and REAP can merit 40 years. But in the hotel space, the USDA B&I program will max out at 30 years. So 30 years is really the only place where hotels will see that term length max out at.